I think one of the challenges specifically for capacity markets is actually how you design a market that doesn't dampen the already really strong incentives we have for dispatchability in the NEM, especially with initiatives like 5-minute settlement coming into play, and to be able to design these contract structures in capacity markets that don't actually bias against high capital cost, low variable cost plants such as renewables and storage. And of course, then you've got the challenge of how you integrate something with duration limits into a structure that's typically looked at capacity as kind of being duration limitless, essentially.
Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues.
Welcome to Energy Unplugged. I'm Hugo Batten, Managing Director of Aurora in Australia. We have Farhad Billimoria in today alongside Rowan von Spreckelsen, a principal in our Sydney office. Farhad and Rowan authored a recent Aurora report on new and emerging renewable and storage contract structures in the NEM. The focus for today's discussion is going to be the Australian energy market and incentive structures to bring on new renewables and firming capacity. Just to introduce Farhad, he's got a very diverse background, but a few headlines. He's currently completing his PhD at Oxford on energy markets. He's worked at Australia's system operator, AEMO, in their market design team. He's also worked at CalPERS, Mercer, and AMP Capital. Farhad, welcome to Energy Unplugged. Absolutely delighted you can join us.
Thank you. It's great to be here.
So perhaps before we get into the complexities of contract structure, let's just set the landscape in Australia's renewable and storage investing scene. And Rowan, maybe we can start with you here. What do you see as the major challenges for renewable investment cases at the moment in Australia?
Yeah, so I think for renewables, there's probably three key areas that we're seeing in the market at the moment. The first would be the grid, second would probably be the policy, and third kind of on the financing structures. So with the grid, we're seeing kind of increasing complexity. We saw that a few years ago with MLFs. We're increasingly seeing it with things like thermal curtailment, system strength issues, voltage, very much becoming more prevalent in the market, and therefore kind of a greater consideration for assets when they're kind of looking for development and looking for kind of financing. On the policy side, so the second item, we're seeing a number of state schemes. So New South Wales announcing their roadmap, Victoria holding auctions, Queensland as well, kind of pushing through with their schemes. We're seeing a whole number of market design questions. So the work that the ESB were doing, and now kind of folding into AEMO, do we end up with a kind of decentralized capacity market? What does the route for the NEM look like long term? And then finally on policy, there's probably the kind of key question we're increasingly seeing is kind of what does net zero potentially mean for Australia? What might that mean for renewable assets? The solution space of where market prices may go under a net zero pathway are quite divergent depending on which pathway policy takes. That would probably be the second one. And then the third kind of key challenge we're seeing is in the financing. So it's very much a buyer's market for PPAs at the moment with the kind of large number of supply that is in the renewables market. There's a lot of green capital out there globally looking for a home, which is kind of squeezing margins. And we're seeing changing contractual structures as well. That kind of we've seen PPAs with the prevalence of things like negative prices in the middle of the day with curtailment. We're starting to see changes to those contracting structures, negative price risk. The New South Wales auction has seen kind of changes to how contract structure are looking like. So less just a kind of an offtake and more looking at kind of fixed shape, fixed volume. So there's a reasonable amount of flux in what contracts are being signed. So those would be the three kind of grid, policy and financing.
I'd probably add one just from my perspective, and I think it is unique to Australia, but it'll be more relevant in California and other markets over time. and that is the rate of growth of behind the meter generation in this country. So for our overseas listeners, Australia's delivering about 2 to 3 gigawatts of rooftop solar a year, which I think is pretty unprecedented anywhere in the world. So we're seeing very low and even negative middle of the day prices in some of Australia's states. So certainly a challenge there for grid scale solar, but also wind to some degree, giving the rising penetration of behind the meter. I might add a little bit of context to one of your comments as well, Rowan. I completely agree with you that the various state-based schemes in this country, you pointed to New South Wales, but also Victoria and Queensland, I think. For our overseas listeners, again, these are basically kind of big CFD style auction programs to bring on more capacity, but where renewables are relatively price insensitive. Now, about 80% of the renewables that have built in Australia are largely covered either by private or public PPAs. But there's a decent chunk of merchant out there, and more of the assets that are getting built now are more merchant. So that kind of weight of CFD backed renewables creates challenges for other types of assets, I suppose. But agree with you totally on all the rest, Rowan. To storage then, so we're going to focus on renewables and storage because they're the contract structures we looked at with Farhad. I mean, Aurora's, I think in Australia, done something like 50 or 60 storage investment cases over the last 12 months or so. Can you talk about some of the challenges and opportunities you're seeing in the storage space in Australia?
So I think probably two key ones to highlight. Revenue certainty. So I think the energy arbitrage business model is well understood kind of globally, buy low, sell high. But we're seeing increasingly the context of extreme events. So Australia had the Callide explosion in Queensland. We looked at some analysis there of kind of what battery returns might have looked like. For example, if you had a battery in Queensland for the 2 weeks after it, you could have made 15% or so of your capex. And 4 weeks after it was as high as 25%. I think how getting the kind of equity and debt to kind of value that extreme event, which may happen 1 in 5 years, it may happen 2 years in a row. That's a complexity that kind of different players are willing to bet on in different ways. I think the FCAS markets, which for non-Australian listeners, these are the ancillary markets around keeping kind of frequency stable. There are 8 of them, and they go in parallel with the energy arbitrage market. So you can do in Australia, you can do a total of 9 markets simultaneously. They are, as seen in Europe and other markets as well, they're typically shallower markets. So the early kind of the 5 batteries that have been in the NEM in Australia for the last kind of 2 or 3 years or so have seen great returns, and typically kind of 70% or so of their revenues have been from those FCAS markets. The key question that we get most frequently is what is the future of those FCAS markets look like in terms of if they're only a few hundred megawatts in size, how quickly do they saturate? Do they saturate to a kind of very low value, or is there a kind of floor price in there based on the kind of the fundamentals of how the market's been designed? So that's kind of another key question. And the third on revenue certainty is what do the future markets look like for batteries? Again, in the Australian context, they're looking at a faster frequency response market, which would add a 10th market to the mix. We've seen a number of, so 2 of the existing batteries in the network, both Dalrymple and the Victorian Big Battery, have both had network service agreements. These were bilateral, they're not part of the market, but they were with the network providers to provide a service, and that's kind of a contracted revenue stream. So that's something that's increasingly seeing a lot of interest because it could provide a bit of certainty in revenues, but again, it's very bilaterally kind of purchased. And then the second aspect I'd probably touch on would be around those financial structures. So,
well, maybe before we jump to there, Rowan, I agree with all your comments around revenue certainty. It's probably again worth providing a bit of context. One of my lines, if lithium-ion batteries are going to work anywhere, it's probably Australia, right? Where you've got a wholesale market that settles at 5 minutes now, and you've got a price floor at minus 1,000 Aussie dollars and a price cap of 15 grand. And you've got this kind of large coal fleet that is exiting over the next 10, 15, 20 years and creating volatility. So when Rowan referred to the Collide explosion there, Collide's a major coal plant up in Queensland. So I think a little bit of that context is potentially helpful, but clearly Australia is a kind of great market for battery, at least in theory, and that is how it's playing out with the current fleet of batteries. Sorry, Rowan, just to add some context there about your revenue comments.
No, I think that's exactly right, and there is a lot of interest, particularly having looked at how well I think there are now 8 operational batteries in the NEM, 5 of which have been on kind of operational for kind of around 2 years plus now, and the returns, I think 4 of those 5 have seen kind of returns on their post-grant capex that's kind of made them after only a few years or so. A lot of investors have seen those returns and kind of look to try and get into the battery space. Increasingly, it's about kind of getting comfortable with more volatile revenue streams and ones that are kind of shallower, essentially.
I think interesting to note, just last week, and I should note we're speaking on the 16th of December, we saw an announcement from Engie and Macquarie about a privately financed battery, 150 megawatts, so sizable, built at the site of an old coal plant to take advantage of the grid connection. And again, that was delivered without any government support or concessional financing, and Aurora did the modelling for that. So I think to your point, and you touched on it there, that there has been state funding previously, but clearly people are enthused about batteries in this country and building them without government support of any kind.
Yeah, exactly. And I think there is a lot of interest as well about what the financing, the kind of contract structures to provide a bit of certainty into those battery investment cases will look like. This is something that Farhad and I touched on in the report that we did, but looking at kind of virtual storage contracts, kind of based on the spread, thinking about whether or not the existing cap market, which is the kind of hedge for extreme prices in Australia. If the prices go above $300, then it's kind of an insurance against that. Typically, that's being provided by gas and hydro, and things were settling at a 30-minute settlement basis. The market's moved to 5 minutes, and there's an open question there about, are batteries actually better designed to defend a cap at 5 minutes? Can you start a gas peaker fast enough to defend? Will we see a bit of a market for batteries in a kind of cap and floor market as well as over a spread? And the other key question we often get is there going to be a market, a kind of proper market for these network service provisions long term, rather than just these bilateral arrangements that we've seen thus far?
Terrific. Well, maybe to pivot there after a slightly potted overview of renewable and storage investment challenges and opportunities. Farhad, in terms of market design debates in Australia, and again, I don't think Australia is any different from any other kind of major market. They all seem to be grappling with their own versions of what an optimal market looks like. In Australia, the ESB, the Energy Security Board, has started to suggest that Australia might move from a wholesale-only 5-minute settlement market to start looking at locational marginal pricing in particular and capacity mechanisms. I suppose, what's your take on that? How do you think it's going to play out?
Yeah, no, we're certainly seeing some really big questions for market design in the NEM, and probably the two biggest questions that we've kind of faced. And they've sort of come up over the years in different forms, but what we're seeing currently is kind of really a number of new aspects, especially in relation to sort of the question of capacity market, either centralized or decentralized investment structures. One of the challenges with designing and working through the idea of capacity markets is really trying to understand, what the rationale and what particular aspect of the market that you're actually trying to, or what particular aspect of the market leaves the gap for a centralized solution. And so we've had, a number of events both in Australia and around the world, sort of illustrating where energy-only and decentralized incentives can have good impacts, but also alternatively can leave gaps in risk mitigation for the system. I think one of the challenges specifically for capacity markets is actually how you design a market that doesn't dampen the already really strong incentives we have for dispatchability in the NEM, especially with something like initiatives like 5-minute settlement coming into play, and to be able to design these contract structures in capacity markets that don't actually bias against high capital cost, low variable cost plants such as renewables and storage. And of course, then you've got the challenge of how you integrate something with duration limits into a structure that's typically looked at capacity as kind of being duration limitless, essentially. So some pretty big questions with respect to that. And then I think with respect to LNP, I think LNP from a theoretical perspective has certainly been recognized as one of the most efficient forms of spot-based pricing. But I think the challenge that we've got here in the NEM is around both transmission and transition. I think that we've got large-scale contracts, business models that have been developed and contracts agreed on the basis of a particular market design, and they're being agreed every day. So the challenge really is when you kind of look at it, such a shift to not just having 5 prices to potentially having 50 or 100 different prices or hundreds of different prices depending on the nodal granularity. It's really this question of how do you actually transition the system over to this new dynamic, and what timeline do you need for participants to be able to make contracts based on these newer designs. And then I think one of the biggest sort of unanswered questions in LNP is really how you then take LNP and impact transmission and network augmentation. And I think one of the important points for Australia is that constraints that are being experienced by renewables and non-renewables assets are not just limited to transmission or thermal congestion. It's dealing with things like system strength and voltage and stability constraints. And so you've got to have an LNP framework that's sort of expanded to also incorporate system and other aspects of curtailment.
Yeah, and I do think Australia is at the bleeding edge of these debates, in that it is a long, thin, fragile grid spread over a large landmass, and that has created more challenges faster than most other energy markets I've operated in. So with those big market design reforms at least on the table, and it's kind of uncertain to some degree, in all honesty, how they're going to play out. How do you see incentive structures shifting for renewables? So in some ways, in my view, we're moving away from this, at least theoretically, pure wholesale market where prices fluctuate at granular levels. And it seems that particularly state governments in this country are getting comfortable with higher degrees of intervention. They want more levers to pull to control the energy transition. I mean, how are you seeing that play out? How are renewable developers thinking about these different incentives in your view?
We've certainly seen a big shift in terms of both participants in the market and incentive structures. If you kind of look back, 6-7 years ago, really the start of the renewable growth trajectory that we've seen, it was really an impetus for large-scale retailers and gentailers to meet their renewable energy targets. And so that drove really a sort of a standard form PPA style of procurement. But since then, as the renewable energy target was being achieved and gentailers started to achieve their requirements, we had a shift away from that style of contracting into new counterparties like corporate PPAs and alternative structures which interact with retail balancing and firming contracts. And so now we're starting to see state governments start to play a much more direct role in procurement. The New South Wales roadmap being probably the most obvious example. And that's also driven a shift towards trialing new contract designs, such as shape-based contracts and others that are really more suited to kind of the balance of risk allocation. I think the traditional PPA had a very simpler risk allocation, and now you're starting to see much more granularity in the allocation of different types and forms of risk in the market.
Well, so maybe let's transition to that then, and talk about some of the renewable contract structures that we modeled. So in terms of trends in those contracts, both private and from governments, what are the trends that you're seeing that in some ways these newer contract structures like Fixshape, fixed volume contracts are trying to solve?
I think when we had the impetus or regulatory impetus to meet renewable energy targets, there was really a drive and quite a large supply of off-takers that were willing to sign contracts. As that's shifted and we've sort of moved away from just this sort of impetus to get to meet regulatory requirements, you've started to see really a shift in the sort of demand supply dynamic with respect to the cost and prices of executed PPAs, and we've really seen those prices come down quite dramatically. And while technology costs have been a big driver, it's important to caveat that there are a number of other factors that sort of ultimately result in that that PPA ticket. Factors like the competitive tension and potentially the race to the bottom for developers. So I think one of the analyses that we carried out was really trying to sensitize and understand what the impact of that tension means on both PPA structures, but then also what you need to recover from the back end to actually make a project financially sustainable. And what we really found was, as you drive down PPA prices in the absence of technology cost reductions or asymmetry in that cost reduction, investors need to recover more and more from the merchant valuation of the project tail. And so that actually gets to a point where the lower and lower you go, the higher and higher you actually need from that tail, which actually stretches the price projections under normal assumptions. And so that's really one of the challenges, I think, of the traditional PPA structures around in terms of impacting value. And so I think what we've seen is shifts away from that traditional structure to more shaping and intraday sculpting of contracts, really from the perspective of trying to balance the risk of counterparties, both off-takers and project developers, in being able to kind of deliver the suite of risks that participants can take. And ultimately, there's sort of that shift has really been quite dramatic over the last few years. And I think we're seeing more and more trends in sort of sculpting contracts and shaping contracts, but that comes with, I think, some really important risk elements that you need to be aware of.
I think Farhad as well, it also, there are probably like two quite big macro trends that have driven all of that, in that the risks have fundamentally changed through that period of time. Like PPAs didn't used to sign negative price risk, and now they do, because negative prices didn't used to be kind of an issue, essentially. And we've gone from a world where corporate offtakes in particular would think about just procuring the total amount of renewable generation to cover their demand, and now it's thinking more strategically about the value of the time that you're producing that power and you're demanding that power. So thinking about 24/7 renewables, which has created, I think it's created this market to think a bit more about, as we transition towards greater proportion of renewables, to then value renewables at different parts of day to different value, depending on what the generation mix looks like.
Yeah, no, I think that's a great point, and I think one of the factors that's also driving this is sort of a broader shift in retailer business models. You've sort of had the rise of the new green-tailers, retailers either independent or vertically integrated, which have been formed with an MO of actually targeting 24/7 renewable procurement or a large significant proportion of their load being served by renewable or zero carbon sources. So that shift in business structure as well has necessitated I think a fundamental reshaping of risk in the markets.
Yeah, I think Sheldon Kimber from Intersect Power is really articulate on this stuff if people want to look him up. So Rowan, we've seen this changing dynamic in the Australian market, as I said, from both private PPAs, 24/7 power, that dynamic, but also from governments who are looking to shift some of the risk away from the public and back onto renewable developers by asking them to deliver Fixshape contracts. Can you talk a little bit about the modeling we did around that? Like, what are some of the key components of these contracts, and what are some of the implications for market participants?
Yeah, sure, not a problem at all. So just for kind of those listeners that aren't super in the weeds of the New South Wales roadmap and what's being proposed there, we've talked a bit about kind of fixed shape, fixed volume contracts, but broadly the idea is there that you would, as it kind of sounds, you would bid in a certain amount of volume to the contract in a year, and you would either have a shape provided to you, or you would provide a shape that you kind of expect to meet. So for a solar asset, you wouldn't provide a shape, or hopefully wouldn't be expected to provide power in the evening periods. If you would, you'd need to be going to procure that elsewhere. So New South Wales is doing this for the first time. This is not a kind of a contract structure that's been seen in Australia yet to date in any kind of scale. So what we looked at is they're kicking off a kind of that contract process. I think it's kind of in the next year or so. So we explored what some of the kind of the key detail that we're expecting to see come out in the kind of regulations over the next year in terms of what will move the needle in terms of those contracts. And the key aspects that change things are, there are 4 of them. So the first one would be kind of the shape itself. So looking at a particular shape, obviously very different for a wind asset or a solar asset, you want it to ideally be tailored to your location, so you're better chance of meeting it. And then kind of looking at what risks are posed by that shape itself. So a good example of this is when we kind of analyze the solar shape, you can look at which periods of the solar shape are the most variable, which also coincide with the highest periods of price. So in Australia, we have a kind of a morning price peak and an evening price peak when prices are typically highest, demand is typically highest. That is the period that a solar farm is ramping up and down, typically. There is the greatest amount of volume variability in those ramping periods, and there's the greatest amount of price volatility in those periods as well, which leads to the kind of conclusion that actually needing to defend a shape in those ramping periods is going to be the hardest point of the day. And you may see in some instances things like negative cash flows for certain half hours if you are kind of short on your kind of contracted shape position. So looking at what that might mean for the shape that you would bid into such a contract scheme of, do I actually want to tighten my shape so I don't look at kind of a full kind of POE 50 style solar shape, and actually I'm going to just provide something that we looked at and called kind of a kind of flat inverse solar profile, where I'd actually only start my fixed shape in at kind of say 8 a.m, finish it a bit early at 4 p.m, reduce some of that vulnerability that I have under that shape. So that was the kind of first component, and it can really move the needle. The second one was on the volume side. So when you look at these contract structures and you look at putting in a kind of a probability of exceedance 90 or POE 10, there's very different kind of cash flow risks from those different positions. If I'm only putting in 10% of my expected volume, if I'm caught short, I'm at far less risk from a cash flow, and the rest is all kind of sitting merchant. If I'm almost fully contracted, then potentially I've got higher risk from a volume perspective. And there is this kind of concept of a contract sweet spot. So if you think about a kind of graph where you took on the x-axis, you think about the percentage that your solar farm or your wind farm is contracted, starting at zero contracted all the way up to fully contracted. If you think about the kind of the cash flows that you would expect to see and the variability in those cash flows, as you start to kind of increase the level that you contract on those kind of fixed volume contracts, you start to see a tightening. You lose a bit of upside in terms of your cash flows, you decrease your downside risk, but you get to a point beyond kind of 25 to 50% contracted that you start to see an increase in that downside risk in particular again, because the possibility of being kind of caught short is high and could lead to kind of material downside risk. So there's a sweet spot of where you would be bidding your volume into these kind of auctions. The third aspect is probably the settlement granularity. So this is something where we see a kind of a difference in the existing PPA market. Some PPAs are kind of settled on a weekly basis up to kind of quarterly is typical. So weekly, monthly, or quarterly is usual. The settlement of these new Fixshape fixed volume auctions will be critical. If you think about the variability at a daily level in your cash flows from having to conform to a certain volume, if it was a particularly cloudy day or not windy at all, you could potentially be short most of your volume. If that coincided with a high price period, you could be very short on what your cash flows and things could look like on a daily perspective. As you start to increase that financial settlement period up to kind of quarterly or annual, that kind of risk on the downside in particular reduces quite dramatically, because you start to see an instance where the kind of extreme downside risk days are offset by better days. So the longer the financial settlement, the less risk and the less kind of cash you might have to hold in the vehicle for the asset. I mean, fixed volume contracts themselves are not new. It's the combination of Fixshape and fixed volume here. But I mean, fixed volume, that's what we saw in Texas. That's what is kind of given a lot of focus recently, given the Texas outage, and a lot of assets on the hook, particularly wind, unable to generate through the storm, and then on the hook for those kind of fixed volume contracts. So it's very much a kind of a focus point, I think, for most financiers in particular, but also developers going into these auctions. So that was the third one. And then the kind of fourth area is around what is the capability for kind of firming that shape that you're putting in. What is your kind of hedging capability, and what is the cost of it? Do you do it with an existing portfolio? Do you think about contracting out to storage, whether it's short duration battery, lithium ion? Is it long duration pumped hydro? Is it a mix? What does that cost look like? And what are the risks for an individual kind of SPV versus a player that's got a full portfolio? The amount of cash that you would potentially have to hold in an SPV for a single asset is potentially quite high under these contracts, quite different to existing PPAs in the market. So does this potentially benefit kind of larger portfolios that can spread that risk across? And I think that's probably the key takeaway in terms of the implications for policy, is particularly on that fourth point, is this highlights the complexity, the different aspects here. The devil will very much be in the detail. And the question, I think, that's still an open one, but this structure will favor greater sophistication and potentially larger participants with bigger portfolios or greater trading capabilities to manage this risk, which may lead to us seeing a bit of a consolidation in the market if this is the kind of the predominant kind of contract structure moving forwards. Although I expect we'll still see a mix in the market with kind of corporate PPAs being still signed separately.
Great summary, Rowan. Thank you. The only thing I'd add, I suppose, is that, and just in the interests of kind of accurate reporting, but the New South Wales government is looking at a number of different contract structures. So they've certainly flagged Fixshape, fixed volume, but have not committed to that yet. But it's certainly something that's attracted attention here in Australia and in the development community. Farhad, I might then turn to storage. So Rowan's talked a little bit about some of the challenges in the storage space, the volatility of revenues, multiple revenue streams. difficult to get project finance community comfortable with some of these cash flows. We modelled what in Australia has been dubbed a virtual storage product, but we looked at a couple of different other ideas to see what contract structures were available for lithium-ion batteries in particular to work around. Can you describe what we meant by a virtual storage product, but then also discuss some of the insights coming out of the analysis?
Sure. So virtual storage is I think a really innovative product that started to really come into the news at the back end of last year and early this year. And the way to think about it is really as a swap where a project, typically a storage project, will receive a locked-in price spread in return for paying essentially the difference between the highest and the lowest prices of the day. And that can be specified based on, potentially the highest, X number of hours, 4 hours is one example of contracts that have been signed. And what that does is actually attempts to replicate sort of a revenue model for storage, which provides more certainty on cash flows. And we've seen it, a couple of examples of that type of contract being inked, most notably with HydroTaz and their investment partners. And I think it's a really interesting model for contract design for storage. And so we spent a lot of time modeling that. And I think we kind of came up with four key insights really around both the positives and potentially some of the challenges of virtual storage. The first is that on an analysis of both historical and future price projections, these contracts can actually improve the risk metrics of storage. And particularly the assets that we looked at, which included both single-hour lithium-ion batteries, as well as longer duration battery storage, is that they can actually support pretty significant volumes of virtual storage. And can financially defend those both through energy arbitrage, but also by playing in FCAS markets. And so I think that was pretty positive. And so we kind of looked at that as a good sign for the design of that contract. The second implication of that is that having that certainty can quite significantly improve the financeability of such assets. And I think particularly in the NEM, some of the arbitrage battery energy storage investment cases have really required some amount of debt funding to secure the hurdle returns that investors are looking for. And so what we find is that having some sort of contracting structure like a virtual storage can really impact the levels of debt that can be supported on a project basis. And we undertook some debt sizing analyses and found that there was actually a degree of ability to support quite significant increases in debt, which actually shifted really importantly from sort of a pure private equity, higher risk, higher return type business case to something which is more adaptable to a wider range of investors like infrastructure funds, both hybrid as well as core, and potentially direct investors. And so that, I think, opens up the space for commercial financing of batteries. And we've seen that, a bit of evidence of that with some of the recent battery financings that have been announced. And I guess what just a couple of points that we'd probably caveat in terms of the analysis is that an important part of the revenue defense for high contract volumes is FCAS. Now, FCAS is not something that you can actually contract on a anything but an ad hoc basis. So you do have a bit of basis risk between the contract that you're writing and the sort of the arbitrage mix that you use to defend that contract. So I think basis risk is a really important consideration. And so that leads us to sort of the final analysis, insight from the analysis that we did, which was really that as the revenue mix changes for batteries, the risk profile changes quite significantly. And so right now, a significant portion of battery revenues are coming from FCAS and are expected to continue to come from FCAS. But particularly as you move past 2030, that really shifts and energy starts to become a bigger part of that revenue mix. And what we found was with that mix changing, what you end up with is improvements in your basis potential, but then also the risk of sort of bigger upsides and downsides as you move towards higher contract sizing. So I think we sort of came away with the view that virtual storage, I think, and related contracts. So this is not the only style of this type of contract, but this sort of umbrella group of contracts, I think, holds a lot of promise. But it's really important that both you cater your business case off that storage facility to the contract and vice versa, but that also you kind of look at the specific elements of risk that you're actually trying to manage and how that changes over time.
Awesome. That's a terrific summary of the work we did. I'm conscious of time. Fab, I might just finish up with a few kind of slightly more rapid-fire questions around your career, which is a very interesting one, I think, in that you sat in the public sector, the private sector, and now academia. What triggered the move back into academia, and what are your current focus areas?
Yeah, so it's funny. It's kind of been a bit of full circle for me because I think I started off on the commercial and practical side, making investments and operating these types of facilities. And as we've really started on this energy transition, to my mind, it's really important to kind of re-examine the fundamentals. If you kind of look at the basis of electricity design developed by folks like Bill Hogan and Fred Schweppe and Paul Joskow, they were really elegant reconciliations between physics of power supplies and power systems and the economics. And so now you've got a big change in how power is supplied into the market, combined with the ability to now store. And so that, I think, reopens the sort of the fundamental questions. And that's really where it drove it for me, was to sort of try and go back to school a little bit and sort of make sure I really understood what we're trying to do here. And so it's a really, really interesting learning experience. And I think they'll be able to take some really good insights back into industry.
I try and stay abreast of the academic literature, but a lot of it is pretty turgid, to put it mildly. Your stuff, I think, does a great job of, clear kind of academic rigor and abstraction, but also is pretty relevant to people who are actually active in the market. How do you think about that? Is it topic selection? Is it the way you problem solve? Is it the analytic tools you bring? Like, how do you keep your stuff relevant, I suppose?
Yeah, I think there's definitely this sort of sweet spot between technical granularity. There's sort of this temptation to sort of over-engineer a model and really try and get real specificity. But of course, ultimately, you're trying to model a real-world system, and so it depends very much on the reliability of those assumptions. I think in academia, they sort of make the statement that you could solve any problem as long as you make the right assumptions. But I think that the really, and there's a few folks that kind of do this really well, is trying to make the assumptions that make the problem tractable, but do it in a way which still conveys important insights for real world decision making. Because I think, especially in the field that I'm in, and I'm focusing on, the idea is to have real world policy and commercial implications and insights. And so there's definitely an art to doing that, and there's definitely some folks that do it really well, and then there's also there's challenges, I think, in kind of making that jump. So it's definitely not an easy one, but some folks do make it look easy.
Awesome. And one final question, and I always ask this, but who do you read or listen to in the energy space that you think is always good, thought-provoking, and, to my last question, relevant to the private sector?
So I really enjoy the sort of the energy podcasts, especially stuff by Shail Khan. I think his new one, Catalyst, is really an interesting one. And I used to follow the Interchange and Energy Gang. And so they're really the ones to just keep you really up to date on what's going on, both in terms of sort of market developments, but also on the technology side, which is moving so quickly. And then I think in terms of sort of reading, anything by Jacob Mays or Jesse Jenkins in the US, Robert Ritz in Europe, and I think in Australia for local flavor, anything by Paul Simshauser, Tim Nelson and Joel Gilmore, really fantastic insights from an academic, but also I think a very practical perspective as well.
Paul Simshauser and Tim Nelson are two previous guests of the show, so you're in fine company there. We might call it there. We've got a little bit longer than intended, but a fascinating discussion. Farhad, thanks enormously for your time. Great discussion.
Thank you. It was great to be here.
And Rowan, likewise. Thanks for your contributions today.
It's been a pleasure. Thanks for having me.
That was Hugo Batten, Managing Director of Aurora in Australia, talking to Farhad Billimoria, Energy Systems Researcher, Energy and Power Group, University of Oxford, and Rowan von Spreckelsen, Principal in Aurora's Sydney office. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening, and goodbye.